Looking for a way to make some money on the stock market, but unsure where to begin? You hear all these words being chucked at you: investing and trading, day trading. So, well, this video, we're going to look into the comparisons between the two: investing or trading. What's good for you, what strategy works well, and the requirements on each side. So without further ado, let's go. Hey guys, welcome back to another video. My name is Mary from Business, Trading and Money, and today we're going to be looking at the key differences between investing and trading. There's more options now more than ever to make money online, and these words are being thrown around tenfold, and that's why I thought I'd make this video, because we need to make a clear understanding that these two strategies are very different and require different amounts of time, skill and resources. So let's start with the first thing, and the first thing first is, what is investing? What's investing? Investing in stocks or purchasing shares is basically buying a small tiny part of a company, or if you've got loads of money, a big part of a company. You are purchasing ownership of a company, so with the future prospect that that company is going to do very well, profit more, and as a result you'll get highly rewarded for your investment. But the key with investing is that it's a long-term strategy. You are planning for the future years, 5 years, 10 years, 20 years down the line, in the hopes that these companies will still be around and they would have really generated value and changed the world and created money and done really well at business. And if they make money, you make money. And we're all happy investors. I mean, those people that early invested into Apple and Google are laughing now, because they got in early, they saw the value, and everyone sort of jumped in after, and the price rose. Apple's now like a $3 trillion company. Crazy. So this time last year I posted a video about my dividend stocks, and I picked a few. I think I only put one video out of the two that I actually created, but due to time. But now I'm going to compare. I picked 10 random stocks, and when I look back at that video, I saw that a lot of the stocks that I picked today were the ones that I picked last year. So had you purchased some of those stocks last year, you would have some positive results. But we're going to go through 10 random ones that I just picked from the S&P 500. So had you in the last year registered with a brokerage account, and if you've not seen my Trading 212 video, you can view that here. A brokerage account enables you to purchase some shares. So this company, I reviewed them, they're very good. If you're a beginner, and especially if you're in the UK and you're a beginner, this is very good for you, and I believe they do operate worldwide. So sign up with them. If you're unsure how to sign up, there is a link below. You can click that, sign up to them, deposit some money, and you can start investing. If you've done these purchases last year, let's see what would have happened. I'm going to go by sector, just picking some random companies, and we'll see where they are from last year till now. Technology. I'm going to choose Microsoft, and looking from the 4th of January till 2021 to 4th of January 2022, I can see there's been a 50% increase. It's gone from $223 per share to now $340 per share, and that's worked out as a roughly 50% increase. Communication. Google, Alphabet it's known as. Obviously they own YouTube, Google Search, and a whole heck of other companies and brands and things. And they've gone up by 65%. Had you purchased back in 2021 January, it was at $1,700. It's now at $2,968 per share. So that's a 65% increase in 1 year. You can go to household and personal goods. So a company like Procter & Gamble, they've gone up 18%. You have beverages, something simple. Coke, this was in my dividend video. Had you invested, it went from $52 to $60, and that's a 15% increase. You got banks like JP Morgan. They've gone up 33%. Oil and gas, a company like Zom, again, another one I mentioned in my videos, Zom, they went up 51% from last year. Let's go with McDonald's. Everyone knows what McDonald's is. 26% increase from 212 to 265. Entertainment, something like Disney. Disney actually went down. It went down. Yes, people, not everything goes up, some things go down, and Disney is one that went down. Disney went down 12%, $185. It's now $155. Had you put your money in Disney, you would have less money now than what you started with last year. And another one that went down, which I actually really loved, was PayPal. That was down 19%. That's a huge amount. Down 19% from $235 to $188. Down, people. Another one which I quite love as well is the Marriott hotels, in the hotel sector. The Marriott Ticker MAR, it's gone up 33%. So we have a variety. I picked 10 random companies from 10 different sectors in that conglomerate of 500 companies, and there was a mixture. 2 up and then 8 up and then 2 went down. So I keep mentioning this S&P 500, and quite briefly, it's just like I said, a conglomerate of 500 companies that were picked by someone and have different weightings. So it might have, for instance, 1% of Apple, 10% of Google, and all these different companies. These are just examples of just simplifying it for you. So these companies are in this chart, which I'll put up here. You can see some of them. And instead of like individually picking, you can just purchase this S&P 500 and you get a percentage of all of these companies, which works quite well. So had you picked those 10 stocks in January, 8 of them would have gone up. Your portfolio value in those stocks would have gone up, and 2 of them would have gone down. So on average, your overall portfolio would be in the plus. You've made more money now than what you had it been under the bed in the bank. Good returns. Plus, with some of those companies, they are dividend stocks, and that means you get paid to give them your money. We love dividends here. So companies like Procter & Gamble, Coke, Microsoft, JP Morgan, McDonald's, they all pay out dividends, and we love dividends, as I mentioned. So you would also earn even more money through the use of dividends. So the value of the stock went up and you got dividends. Win-win. Guys, win-win. So in just 1 year, your portfolio would be worth more now than it was a year ago. This is investing. Guys, we've invested and we've made money. You are taking money and making it work for you. It's a long-term outlook. I know we just looked at 1 year, but it's a long-term outlook with the hopes that the price will continue to rise, you will earn dividends, and the value of your portfolio and money becomes more. However, it's important to pick and choose good companies that are delivering, that are investing, and have a sound balance sheet and financial situation. You don't want to put your money whereby they're just like wasting it, or they're not giving you value, or they're in a lawsuit, or they're being sued, or they're killing people. You don't want to put your money in bad places, you know, because you're not going to get a return back. At the end of the day, you're giving your money to them, so it needs to be good. You need to do your research and due diligence. Everyone talks about due diligence. I hate that phrase as well. Do your due diligence. Yes, but you must. It's the thing. You have to do your homework behind all of the companies that you choose to put your money in. So that's investing. It takes some time. You need to look into the companies. You've got to pick which ones you think are going to go up. You need to consider all your resources that are around you and things that are going on before you put your money in, to make sure you can get a good return. At least stay positive. The good thing now is that there's so much information online and out there. Heck, you can just look it up on YouTube. You can look everywhere. You can see what these companies are saying every quarter. They also have to release their results, how much sales they've had, their delivery numbers, if they're cars and things like that. They need to release this and let the public, the investors, know what's going on. So you have a good understanding about, do you know what, I like this company. They've had 3 quarters of good sales. They've got a good management team. They know what they're doing. They're investing in themselves. I think this will be good in 2, 3, 4, 5, 10 years time. I'm happy to put my money in here and I can go to sleep at night. So that's when you're individually stock picking. However, as I said, there is an easier way. You can just invest in the S&P 500 and you put your money there and it divides up into 500 different companies, and overall it goes up and you still get your dividends as well. So the S&P started about 1957. It was created. Someone decided to come up with this idea of putting 500 companies, and it changes. Back in 1957 there would have been different companies to what they were then to what they're in now. Like these advisors, these special people, they do their research about which companies they feel should be inside this chart and this group of companies. Since its beginning in 1957, it's had an average rate of return of 10%. Obviously some years are higher, some years are lower, but it averages out at 10.5%, which is pretty good. Again, if you're in the banks, if you've got the ISAs are around 1.1%, so if you're getting 10% instead of a 1.1% return, that is fantastic. And that's what you want. You want to put your money to work harder for you, because inflation at the moment is eating things away, and that's the word that's being chucked around everywhere. Inflation, inflation. Things are getting more expensive. That is inflation. Your money goes less. So if it's in the bank, you're earning less. Think of other ways of putting your money in, and that's where investing comes in. It's why it's so important. And it's why we're on this journey together. Okay, so whilst it all sounds very good, timing is actually everything in the stock market. And there is a phrase that they say, it's time in the market versus time in the market. And that phrase actually is a nice segue onto trading, because trading, you're in for a shorter length of time and you're trying to time the market at the best possible time to get in, get out whilst things are high or low, and then get out when it's high. That's the goal with trading. Whereas investing, you're thinking, no, this company is going to go up regardless. I've got a 10-year time scale. It will go up. I'll be fine. So they're the two polarizing opposites between trading and investing. Investing is more length of time. Trading is short spurts of time. So let's delve deeper into trading, because I love trading. In fact, I love both. I do engage in both of these different strategies, and I enjoy both of them. And to be fair, my investment portfolio has certainly helped me versus my trading portfolio at the moment. So let's go into the trading side of things. Well, trading is where the fun begins. And also the losses. Oh, the losses, the losses, the losses. Oh my goodness, the market at the moment is crazy, guys. Compared to last year, last year I was still laughing. But as I said, my investment portfolio saved me. Because my trading portfolio, my swing trade portfolio isn't doing very well at the moment. But anyway, that's another video, another day, another video. Okay, so the stocks I listed in the top half of this video, ones that I personally picked out that I quite liked. I knew these companies, I liked these companies. I couldn't see them going anywhere in a long while. And I thought, okay, I think these are safe options for me to put my money in. I should get a return back and I'm gonna go with it. I did my due diligence. And obviously, as I said, there were some winners and some losers. Disney and PayPal were losers at those particular time points, whereas all the others were very positive. Trading is more short term. You may purchase a company for a day and then exit at night. Alternatively, you can do more of a swing trade, which is anything from more of a week, a month, a quarter, a year. A year can even be a swing trade. You can swing trade a year. It's more of a short-term time length, but not as long as investing. So again, anywhere from a week, 2 days, 4 days, a month, a quarter, a year is a swing trade. So it has a bit more of a longer time than a day trade. However, it uses very similar techniques. You are really looking at the charts. You're looking for catalysts and news and information that comes out that's going to boost the share price in the short term. And you're going to make money off that fluctuation from it hopefully buying in low and it going up. And so within even the day trade versus the swing trade, they have different strategies that you have to adopt in order to succeed in them. And they all require different amounts of time, different types of amounts of money, and different amounts of time for yourself to invest to doing those and pulling off and hopefully having a successful trade. A brief summary. Day trading is you're in and out of a trade within 1 day. You're needing or expecting the stock to go up or down depending on which side of the fence you're sat on. And things that affect the stock from going up or down is things like the news, earnings. So earnings are when they give their quarterly reports to say the company's done well or badly. Company releases, so if they, new CEO, for instance, Twitter, the owner of Twitter got fired or he quit or whatever. And obviously the share price went up. They were happy to see him go. And that's gone back down again. Everything just keeps going down. Analysts, people that analyze, like their job is to sit and analyze companies and stocks. They can put out a statement and it can cause the stock price to go up or down. Product launches, PR, dividend changes, like AT&T, that was one of my stock recommendations for dividends. They cut their dividend because they wanted to invest more in the company, which is good in the long run, because it means that they're putting more money into the company rather than just shoving the money out. It's good in the long run, but it's not good if you're a dividend investor wanting dividends, because if they're not paying dividends, then why are you there? So as a result, it causes the share price to fall down. And if you're swing trading that, and if you're expecting the share price to go down, you would make that assumption, make that trade that the share price is going down, and you would have profited. Over the past year, that share price has fallen ever since they gave that announcement. But having said that, yesterday alone, it was one of the best performing stocks in the market, and that just tells you how the market is at the moment. Not good. So yeah, there's lots of all these things that can come in that can affect the share price to make it go up and down, and your goal is to try and anticipate those changes and purchase in at a lower and ride the wave up and then get out in a short window, whether it's a day or a week or a month or a year, etc, etc. It sounds easy, but it really is not. It's not easy. But with time and learning, it gets easier. And the thing is with trading, you have to expect that you are going to lose money. It just happens. You're going to make money and you're going to lose money. Consider it the cost of business. It's the cost of the market. You don't know all the information that's going on or what's happening out there. With day trading, some key differences: you're going to have lots of trades, a lot more trades. You're likely going to need a higher share count because you need to purchase quantity of shares, because you're hoping that it might move a dollar maybe, so therefore you need a lot more shares to be able to get that movement and that revenue profit. It's over a short time, sometimes minutes, hours or seconds or days or months, and you need to be actively sat at the desk to see the share price change, to receive the news that comes in. And with that, you need a platform that has enough information, that's fast, that gives you more detail into the market, to give you as much information as you can to perform the best possible job at day trading. In day trading, you'll find that you'll have a lot more executions of trades. You'll be doing lots of trades. You might go into a good 10 trades, or to be fair, if you do less trades in a day, you will have to increase your share amount, so you will have a lot of money to be able to trade that many shares. It's a short time. It might be seconds, minutes or hours, but it's one day that you're holding on to those shares for, and you're actively sat at the desk waiting for news, catalysts, changes in the share price. With that, you need a good enough broker that executes quickly, because those pennies difference are very important. So you need a good broker that can do that. I recommend Interactive Brokers for day trading, and I'll put a link below if you want to sign up with that. It's a bit complex, but I will put a video out on how you do sign up with them. And the key differences that come to mind with day trading. With a swing trading comparison, you will need less smart or quick executions, because you're not really so fussed about the penny amount, the price that you get. You are hoping for a big move, maybe $10 or $20 of a stock that goes up, and you make your money that way. Something like Trading 212 or Think or Swim in America, if you're in America, these are good software platforms that I feel are very good for executing these trades. But with each method of trading that you choose to take, it's very important that you are clear on your strategy and plan. If you're going in for a day trade, keep it as a day trade. If your plan is to swing trade, keep it as a swing trade. Don't intermix the two, because that is how you lose money. Once again, believe me, I know. I've learned the hard way. I've turned my day trades into swing trades, and no, it's not a good look, guys. So there we have it, guys. The difference between investing and trading. Two different techniques and two different methods that you can use that can make money. As a beginner, I would say start off with investing. It's slightly less risk. Just start there and then progress your way through, because with trading, you need to really look at the technical analysis of charting and charts, and it involves a lot more external resources to work out what stock is going to go up and will you make profit this month. But both strategies are fantastic, and both should be in your toolkit to use in this world that we're living in today. If you want to make money on the stock market, you need to know both, I feel. But there's just so much information. It's so fantastic. It's just a brilliant space to be in and to know and to understand. So start your journey today. Invest. Open a brokerage account. At least just start. You don't need lots of money to begin investing. As the ads always say that you may have seen, it always says just open an account with £1. You can do that. Just start with something, because it begins you on this process. And I don't want to say it's addictive, but it is addictive. This whole thing is addictive. It's amazing. Because especially when you see your portfolio go up, it's a great feeling. When it goes down, it's not a good feeling. I'll give you that. It really isn't a good feeling. But know that you can live to another day and try again. So that's it, guys. Be sure to subscribe and like, and thank you so much for watching if you've made it this far. Again, my name is Mary from Business, Trading and Money. I hope to be back very soon with another video, and I'll see you then. Bye-bye.